So therefore, what we're trying to get is that nice combination of capital growth and income. And I think that's going to be the differentiator for clients.
Welcome from the Fonds Professionel Congress in Mannheim. I'm here with Mortimer from Guinness. Hello.
Hi, nice to be here.
You're running an income fund, an income strategy at Guinness Global Investors. The big question is fixed income is back as an asset class. Do you see any reaction from investors moving from income back to fixed income?
Yeah, I think it's, there's a balance ultimately. So we're running a kind of an equity income fund. So we're trying to generate the income distribution through the dividends of companies. And I think, we have seen some of that change. And I think the way we would kind of think about it is not necessarily, which is better per se. They have different, potential return outcomes. But I think what we would always go back to in terms of the difference between a fixed income and an equity income opportunity set is really the opportunity for capital growth alongside. We have been in a high inflationary environment, and maybe that's what's maybe changed in investors' mind. But inflation still remains somewhat high, and that's a big question mark for markets. But what we're looking for in our equity income strategy is rather than a high yield, kind of bond proxy like, we're actually looking for a more modest dividend yield. The fund's trailing dividend yield's just over 2%. What we're really looking for is companies that can successfully grow their dividend over time, and that should be aligned to the company itself growing. So therefore, what we're trying to get is that nice combination of capital growth and income. And I think that's going to be the differentiator for clients. It's sort of, if you're getting a fixed income opportunity, it's more about the kind of price changes and the ultimate the coupons you're getting. But the opportunity for capital growth is not necessarily, it's not really there, right? And by definition. And so what we're arguing for is, I think from our perspective, yes, I think fixed income can make part of your diversified portfolio, but I think also it's really important for clients to have that exposure to, growing companies that can, successfully grow the capital in terms of your total return as well.
And looking back, how was the dividend growth last year, and maybe what you're expecting for this year?
Yeah, so it's a great question. I think when we're looking at our portfolio companies across 2024, it was actually one of the strongest periods for the kind of the average company in our portfolio in terms of their dividend growth. So if we're looking at our 35 companies, the average dividend growth was about 8.2% last year, which is probably one of the highest growth levels we've seen. And that was actually across the portfolio, interestingly. So it was through financials, industrials, consumer staple businesses. Healthcare was maybe a little bit more modest or more in line with what had happened historically. But I think that's a good reflection as well, by the way, of these companies managed to grow their earnings. So actually, I think through this inflationary type period, a lot of these companies we're owning have managed to pass on those costs, continued to grow, and I think that's somewhat a reflection of the strong consumer. Our view for what's going to happen in 2025 is maybe a little bit slower, I think, because I think as the inflationary environment stabilizes, it may be more about kind of volume growth than price growth in simple terms for these companies. And if we're going more to that kind of volume growth in terms of driving top lines, then potentially, that's harder to see, that's harder to achieve, if you like, from a sort of physical point of view than rather just price growth. But ultimately, still a pretty positive outlook from a dividend perspective.
You're still very positive or quite positive on the consumer staples sector. Why is that the case?
Yeah, so consumer staples is one of our biggest overweights. It makes up about 25% of our portfolio. It's been an area we've had good exposure to for a number of years. It fits a lot of what we're looking for, sort of quality companies, strong balance sheets, stable and growing dividends. And I think it's been a little bit out of favor. I think they did really well through the post-pandemic period, actually, through that ability, like I was mentioning earlier, to kind of pass on higher prices, which I think was not necessarily seen by the market as being possible. Whereas now, I think, because the market's been so focused on tech and growth, the relative valuation of that sector is actually at some of the lowest levels we've seen. So, and if we look at what the companies are saying, I think, yes, we've seen impacts from higher commodity prices, companies like Nestle. But just this week, we saw Procter & Gamble come out and actually say prices are flat, but volumes increased 3%. And I think if you start to see more companies coming through in that sector showing that type of volume growth, then actually I think there's a potential for that re-rating. And obviously some of the things we saw this week in terms of DeepSeek and everything else, you saw the attractiveness of that sector. they were quite defensive. They actually, when the markets get worried, they perform really well. And that's part of the job they'll do in our portfolio too. So if we look back to last summer and August, the big market sell-off, some of our best performers were clearly the consumer staple businesses. So we're trying to think about, what their role is, as well as, individual companies and, the return opportunity.
You have a very stable strategy. You're not like a day trader or something like that. But did you do any rebalancing in the portfolio, like from company-wise or position-wise?
Yeah, absolutely. And you're right. Yeah. So we run a 35 stock, approximately equally weighted portfolio. We only made one change last year in terms of name. So it was pretty low turnover, which is generally thus, but maybe a little bit lower than average. But yeah, absolutely. We do take advantage of those market movements. So as I said, sort of coming into the beginning of the year, we were seeing the kind of, let's say, consumer staples again and healthcare were pretty, unloved. Partly that was growth was doing well, but also partly, particularly on the healthcare side, the new Trump administration and so forth. So we took the opportunity to maybe increase some weights in some of those areas. And then quite pleasingly, that's worked out quite well. And we're not trying to do market timing. We're just trying to sort of use that rebalancing process to think about where's market sentiment? Has it gone too far? Has it gone too high? And then trying to use those sort of short-term market movements maybe to our advantage when we think about actually our long-term investment horizon is, 5 years plus.
Thank you very much for your insights.
Pleasure. Thanks for having me.